Thank you so much for coming to our seminar this year, Lucky to be Canadian. I'm Jennifer Tozser, Senior Wealth Advisor, Portfolio Manager, and I have been doing these for quite a long time. So I'd like to do a quick recap of last year. We had a great year. It was a great year. It's not going to be as great this year, but I am pretty constructive that we are going to be able to make returns that are decent. I expect hopefully in the 8 to 12% range. So on that note, I want to get going and start with our basic agenda. And here we are. This is what we are going to go through this year. I expect it will take me probably about 45 minutes to go through these topics. So here we go. Let's get started. The U.S. election. We have to talk about it. So it was a clean sweep here by the Republicans. So the market is rallying, but here is the irony that when it's a clean sweep, it doesn't matter if it's the Democrats or if it's the Republicans who make the sweep, because in both situations, chances are that the market will do well. Now, I know that some of you are shaking in your boots because Trump is, but I'm not, because Trump is pretty consistent in his priorities, and I feel that we can navigate them. So his first priority is the U.S. is first. It's pretty obvious. His second priority is to control illegal immigration. Now, I believe that this was the pivotal topic in the U.S. election that wasn't really widely talked about, but which is one of the reasons that the Republicans won. And this is what's incredible to me. This is a small slide. But what's incredible to me is that the Republicans picked up percentage points in every single state but Washington. And when I talk about that, look at California. In California, the Republicans picked up 7 percentage points. So what that means is that the Democrats used to have a 25% spread in votes over Republicans, and that decreased by 7%. And if you ask me why, I'm going to tell you, I guess, this is guessing, but I guess that people are just frustrated. And they're frustrated because their standard of living was declining, crime was increasing, and they felt that their generosity as a country was being abused. On to, decreased regulation or increased competition. We have fiscal policies now that are going to promote business, such as extended tax cuts, and monetary policy. So for monetary policy, we do expect some rate cuts in 2025 from the U.S., but not so many as to be stimulative. And finally, the one that's on everybody's mind is tariffs. Now, yes, tariffs are going to get their own discussion later on. But in summary, there is a debate about whether or not U.S. tariffs are going to be good for Americans, but there is no debate that U.S. tariffs are going to be bad for everybody else. Okay? So as a group, these policies are going to provide some tailwinds to the U.S. market. But now on to Canada, and how are we doing? But before I get into the slides, the fact that our Minister of Finance, she, didn't want to present her budget and would rather resign, and then, our PM Trudeau retired, I think that's going to tell you probably what I have to tell you. All right, so who knew? So whether you look at per capita per person, or you look at income or output, there has been no growth in Canada since 2015. And the gap between our progression and the U.S. is worse than it was even in the 1990s. So because of this number has not been visible. And the reason it hasn't been visible is population growth. Now, this would be a great slide if it was a stock chart. Okay, but it's not. It's population growth. And so just take a guess. Of the population growth that we've seen, take a guess what percentage is from immigration? Who said 100? 150. Wait a second. You guys didn't play the prices right. You can't go over 100, but it's 98. 98 of our population growth is from immigration. And of that, 60% of our population growth, of that 98, is temporary residents. So students, foreign workers, etc. Now, we do have some policy changes to immigration, which are good, and we expect to see a decrease of the increase by about 25% next year. But this is an unspoken problem, is that if Trump makes good on his deportation threats, we could get quite possibly overwhelmed by a migration surge. And right now, the RCMP is stating that they're between 2,000 to 3,000 border workers short. So it's going to be something difficult to manage. And unfortunately, there's not a very short-term solution in sight. So we'll now look on to our shining star, which has been housing. And this slide shows the very real growth of housing prices and the growth trend that we've been on. We have outperformed in Canada every G7 countries when it comes to housing. So I don't think that this next statement is going to be very surprising when I tell you that the outcome of that is now that housing in Canada is very expensive and is not affordable, which is our next slide. So I'm going to read through this slide because it's not intuitive. If you look on the top left there, that's the cost of a house in Vancouver, okay, 1.7 million. Going across to the right there, the average house has to make about $346,000 to be able to support the house, which is 447 months of saving, which is over 25 years of saving money to buy a house with a 25-year mortgage, which is obviously not correct, or not sustainable would be the actual word. And you take over to the next side, which is 93.9%. That is the premium, the excess cost that you're paying to live in Vancouver versus Toronto, Montreal, or other Canadian urban centers. So what do people do if they want to own a house? Because, of course, we've seen that there's been lots of great growth. They move to a condo. And if you take a look at this condo, well, there's $753,000. Okay, it's reasonable. It's $177,000 has to be your household income. You can save the money for your down payment in 66 months, which is just over 5 years, which is not bad. But the trick here is a 57.3. And what that 57.3 is telling you is that it's 57.3% more expensive to own a condo in Vancouver than it is to rent one. So if you look at this little chart here, so if you buy a property that you can afford in Vancouver, which is a condo, you're feeding your condo. So this for me is just a glaring slide. By the way, just take a guess. What percentages of mortgages do you think are coming due between now and the end of 2026 in Canada? And it's not zero. 25, 66, 60. And this brings us now to my next point, which is the job market. This is, again, not the greatest news. This data is at the end of October. The jobless rate was over 5.5. And guess where you think it's going to be now, higher or lower? Higher. It's higher. Yeah, 6.7. Okay, so I'm not completely depressed. Remember, lucky to be Canadian. It's coming. It's coming. Okay. But again, we have another big differential and the trend's not good. And so we've got mortgages, we've got joblessness, we've got immigration. So now we're going to talk about the interest rate differentials. And what that means, an interest rate differential is the difference on what you get in the US versus Canada. So if a 10-year in the US, I'm making these numbers up, is 5 and we're 3.5, that's an example of a differential. And right now, the interest rate differential is the largest it's been in 25 years. Okay, so it's pretty big. And it's widely expected that the US Fed will cut a couple times next year, but Canada has to cut rates. So I would expect that differential to continue to widen. And that leads us to our next slide. Please laugh, don't cry. Okay, but yes, this is what you can expect. Unfortunately, the dollar is going to be pretty volatile. So what should we do? So let's start with a recap of the S&P 500 and the market leaders. So no surprise here. The top 7 stocks of the S&P 500 were up 67% last year. And why I put this cartoon up is to talk about how the market growth is broadening even at the top. So we used to talk about the FANG stocks, F-A-N-G, then it was F-A-A-N-G, and then there was Tesla, and now here we are at 7. So this is actually a broadening of the market. So this slide is actually even more constructive. Not only are the leaders up 67%, but the lagging 493 stocks are up as well. And just take a guess. So I told you the leaders are up 67. We know the S&P had a great year. Guess what the average is of the rest of the stocks? It's actually 4.2. So when people start, I'm going to talk more about valuations, but if I said to you, hey, the S&P 500 was up 4.2% last year, you wouldn't be saying, oh, we're overvalued, right? So And then here we go, 332 stocks out of the remainder of the 500 were actually positive last year. And this is good because usually in a bull market, the whole market starts to rise. And then at the end, there's only a few. This is the opposite. We had a few and the market's broadened and now everybody else is starting to come along. And that's one of the reasons. So that's the reverse. And that's why I'm pretty constructive because the market leaders started the bull. And now that we've got more that are participating, I believe we are more towards the middle than the end. So we're continuing to hold our market leaders and we'll be adding smaller company exposure to the portfolio as well. By the way, just fun quiz. Guess what the top 7, the range in the top 7, the highest one was 171%. Guess what the lowest one of the top 7 was? This is the top 7. I heard 100?
45.
45?
30.
30? 12. 12. Okay, so that's a pretty big difference when you're watching numbers. So let's take a look at the rest of the world for a second. The U.S. has been leading. I'm not telling you anything you don't know, but this slide is a little tricky. And what it shows is that the U.S. has outperformed the rest of the world by about 5% per year, compounded back to 1992. Okay, so the bottom part of this stock talks about valuations. And often you'll hear, oh, the U.S. is expensive, the U.S. is expensive, the U.S. is expensive, Take a look at this, the pink on the bottom. It's been perpetually expensive for every year except for 2008. So just expect that it's going to be, based on traditional valuation metrics, expensive. So another way to look at this number, to talk about this comparison, is what would have happened if you'd invested your dollar back in those dates. So you would have had $50 if you were investing in the US, 17.5 if you're investing in Europe, and about $8 if you're investing in emerging markets. So again, you might ask, well, how is that possible when the US is so expensive and valuations are stretched? And there are many reasons, but an obvious one is that where other countries dilute their wealth, the US consolidates it through share buybacks. All right. And that's the gray part of the graph, something that you can see other countries are now starting to do, and the emerging markets have always done the exact opposite of. So here's what this means. Okay. So this is my pretend little lesson today. You get to be CEO of a day. It's a very easy company. It has $1 million of sales. It has $500,000 of costs and $500,000 of profit. So what can you do with your profit? You have your choices. You can reinvest the money, you can pay dividends, or you can buy back shares. Those are the 3 most common things. So in my example, I just assume that we reinvest $300,000, we pay dividends of $100,000, and we buy back shares for the other $100,000. So let's take a look at the next slide. And what does this mean? In this example, what's also really important is the company has the same results in each subsequent year. They're not actually growing as a company, okay? It's the same. So they had 100,000 shares before. We bought back 10,000 shares at $10, okay? Because we had 100 grand. So that's what we did. So now our shares went from 100,000 down to 90. The next year, they had the same earnings per share, but so instead of having $5 a share, they had $5.56 per share because they only had 90,000 shares. And then their dividend of $1, which was remember, was $100,000 that I paid out in dividends. So you didn't have to divide it by 100,000, only by 90, so you got $1.11. So which way do you think the stock price is going to go, up or down? Yeah, up, right? There's a lot of different ways you could estimate that the stock price is going to go up, but the basic one is that if you had a dividend yield of 10% and now it's $1.11 and you still have a dividend yield of 10%, your stock price would be $11.11. So in this specific example, the overall return to the client is actually closer to 20% in a company that's not growing. That's what I want to talk about, why share buybacks really can have an impact on stock price performance. So here's some research. I'm going to talk about this as well. So this is some research that I pay for, in addition to the research I get from National Bank, et cetera. And why I want to show this slide is it doesn't show price progression, but price over time compared to the estimated fair value. So the stock in this picture is up 13.3% to the end of November, and that instinctively makes us think that the stock is more expensive than it was before. But is it? Well, you can see in this situation, the red line being the fair value, you can see the stock is still trading below its fair value because the company has grown. That's the trick. So these are some of the things we're looking for and why I'm not shy about buying stocks whose price is already appreciated. Your price can appreciate if your company is growing. Okay, that's a key thing. And that's really a part of our theme for 2025 is that the growth in the stock market is not going to come from a change in interest rates or because of multiple expansion, but because companies are going to grow their earnings. So let's talk about tariffs. So before we hit the punchline, I'm going to circle back and talk about free trade. And there are two main points to free trade. The first is that if you get rid of bureaucracy, costs will come down. And the second is that you can increase productivity by removing mundane tasks from skilled workers. So now we're going to talk about the reality here. So this is the concept, and I'm going to compare this to what could actually happen. So let's say I earn $30 an hour. Well, therefore, I should not do any work that costs less than $30 an hour. Instead, I should pay people to do the cheaper work so that I have more hours available to earn $30 an hour. That's the concept. But the reality is that there may not be more work to complete at $30 an hour. The person doing the cheaper work at $20 an hour may be replaced by an even cheaper worker in a foreign country and may not have the skills to perform the $30 an hour job. And the problem is when you don't have enough $30 an hour jobs or you don't have the skills for them, all you've done is take a productive domestic worker and make them unproductive to the benefit of the foreign country. Okay? This is the argument that's going on right now. So let's take a look and see what he's trying to accomplish. And of course, again, in my oversimplification, we're just going to look at jeans here. So here we have two pairs of jeans. One's made in the US and one's made in China. The ones in the US cost $100. The ones in China cost $75. They're exactly the same. You can't tell the difference. If you're showing a pair of jeans that costs $100 and a pair of jeans that costs $75, and they're exactly the same, and you can get them at the same place at the same time for the same amount of money, for cheaper money, you're going to buy the jeans that cost $75, right? That's typical human behavior. But what is the reason that the jeans from China are cheaper is because they don't have the standards of safety, wages, healthcare, to name a three. And then if you were to quantify the advantage that Chinese manufacturers have because of the lack of standards, you could add $25 to that cost. And now both pairs of jeans cost $100. So now if you're sitting, same thing, they're sitting beside each other, both are $100. One's made in China, one's made in the US. Now which one are you going to buy? Chances are, if you're American, you're going to buy the American one. So that is the concept of the tariffs. And so why has he made a blanket tariff? The question is, how do you define the source of a product? Is it where it's manufactured, where its components came from, or possibly who the owner of the company is? So it's a very complex question. So I revisited the old Auto Pact Agreement. Does everybody remember that one? As other tariffs, right? So it was successful for a 35-year period. And here's some of the highlights. 75% of the components had to be regional. 70% of the steel and aluminum had to be North American. A significant percentage of the workers had to earn $16 an hour. Now, I want you to think about that $16 an hour for an agreement that's been gone for decades. Today, the minimum wage is $15, so this is a good wage. And I would say that this was a very successful agreement. Okay, but fun fact, the WTO ruled it illegal in 2001, and the Auto Pact got superseded by NAFTA. So these things can work. Not everything has to be free trade all the time. So what about Canada and energy? Because that's what we really care about here. So let's just start with oil. Okay, so currently the US is the largest global producer of oil and gas, but they still do import. Take a guess how much they import. I know some of you know the daily number, but give me a round number.
4.5 million barrels of oil.
Okay, that's right, 50%. 50% of the US daily requirement is actually imported, and 60% of that, which is a number Jim gave us, is the number that comes from Canada. Okay? So that means that of the daily oil requirement in the States, 30% is from Canada. Now, this is a photo that OT took. That's my husband when we were in New York. And he had to fill up the car, and he wanted to prove to me he actually just filled up the car with gas. I'm going to tell you that if we had to have this, if there was a tariff put on oil at that level, there would literally be a riot at the pumps in the US. You just couldn't do it. Look at the price now, okay? This is my long-winded explanation, but just show us what this is. Just take a guess. $7.99 US a gallon. What do you think that is today in Canadian dollars? $3. $3 a liter right now in some American states. They don't have a lot of wiggle room for any increased costs. That's my point. So I believe that we are going to see potentially blanket tariffs on many Canadian items, but on energy, it's going to be a special situation. I think it would be too punitive, too fast to the general American economy. So I'm going to switch gears here and talk about AI. And this is a theme. So companies will use AI to be more productive for cheaper. On this slide, most people assume that the growth in AI that's just been occurring is because of a new technology, but it has more to do with the cost of processing the data. And that cost has fallen by 86% over the last 2 years. Okay. So as something becomes cheap and useful, people start to use it. So what's happened is that the amount of electricity that these companies are using has increased dramatically. So let's take a comparison here. Okay, so this is, critical power that's being used. The orange bars are base energy requirements, and they're growing modestly, but, it's not anything that's going to cause any kind of panic. But look at the blue bars, all right? This is the amount of energy being used for AI, and it's causing an explosion in energy requirements. In 2022, the amount of energy required compared to base requirements is negligible. And by 2028, you can see that the relationship changes. And as a society, we will need more than double the energy that we would have expected to need before the integration of AI. So to put it into context, right now, ChatGPT has about 2 million requests per day. And that is 17,000 times the energy consumption of a typical household. And I'm going to tell you, I think we're just at the beginning. So now that we know that we need energy, where is the best place to get it for future growth? Well, they're going to take what they can get, but which one can they grow the most quickly? I think it's going to be nuclear. That's right. That's what I think. And it's because it's steady and it's reliable and the costs are coming down. It can be pretty cost efficient. But what nuclear has not been, here you go, it's not been popular, but the reality is that how people are feeling about nuclear energy is starting to change. And that's our next slide. That's a Gallup slide. You can see that there are more people, the trends have changed in both directions, where there's now starting to be some, support for energy. I know for politicians, building a nuclear facility is great for jobs. It's great for infrastructure. It's great for a whole bunch of things. But I'm going to tell you, it's not a place people are going to want to walk to work. Use my jewel. Okay, so knowing all this, what's the opportunity? You can see nobody's paid any attention to nuclear for 15 years, and we're going to need it. And I'm not the only one who thinks this, right? There's Microsoft. When would you ever see an IT company buy recommission a nuclear facility? It's already happening. They recognize that they need to control their energy source. Everybody's going to just start to boycott AI and ChatGPT so we don't have an energy problem. Imagine how that worked with cell phones. On to the next slide then. We're going to just talk about portfolio management and risk. So we had a great year in 2025. We were up roughly 24%. So it was a big year. And one of the things that's great, but one of the things that can happen after a year like 2024 is you're talking to your friend or you're listening to the news and somebody says, you talk about your performance, somebody says, oh, that's because you have a high risk portfolio. Okay. Well, that's not true. You know the names that we own. What we have is a high growth portfolio. And that is defined at our firm by having less than 20% in bonds and up to 30% in structured notes. So I want to talk about some commonly heard financial sayings, right? You can hear, these are assumptions. You can hear, oh, you should have 60% in stocks and 40% in bonds. Or maybe you would hear, oh, the amount you should have in bonds is your age. So if you're 82, you should have 82% in bonds. Or maybe you've heard you should have a retirement-based portfolio so that by the time you retire, you're really on the fixed income. I mean, that was okay in 1950 if you were going to, retire for if you're going to live for 3 years after you retired. But today that doesn't really work. And it's an oversimplification because one of the other assumptions is that different asset classes have different risk profiles. And it's commonly accepted that a bond would have less risk than a stock. But in 2022, conservative investors felt ripped off because when the market was negative, bonds significantly underperformed stocks. And what was worse is people were relying on them to be stabilizers and they weren't. And this is why. Okay, because people confuse diversification with correlation. Okay? I believe bonds are a diversifier. Bonds are a diversifier, but this is correlation. So correlation means, do investments go in the same direction or the opposite direction? That's what it means. And I hear people tell me, oh, well, if stocks go up, bonds go down. If bonds go down, stocks go up. It's not true. You can see here, there are various periods of time that are quite long where that is true, where stocks and bonds have negative correlations. But look at this. These are long periods of time where this is positive correlation, where your stocks and bonds are moving in the same direction. And it's not just a one-time thing. It's so much time that I would tell you the correlation is spurious, which means there really isn't a correlation. They are affected by their own factors. So yes, bonds are a diversifier. Bonds are a good diversifier, but you just need to know that they're not correlated to stocks at all. Okay, because they're impacted by different circumstances. Okay, so another diversifier, we're kind of move on here, is our auto callable notes. And I talk about these every year. I call these volatility plays, right? These make money in times of volatility. And I always like to take this opportunity once a year just to refresh how they work because they're not very intuitive. So I've been showing the same example for years. And it was back when the S&P 500 was 1,400. So the contract said, in 1 year, if the S&P 500 is 1,400 or greater, you, the client, get 8.25%. Then if it takes 2 years, you get 16.5. If it takes 3 years, you get 24.75. So this is all lovely, but what happens if the S&P 500 never goes up? Well, if it doesn't go up, you have barriers of protection. The barrier of protection on this example at the time was 20%. So if in 3 years, the S&P 500, instead of being 1,400, was 1,120, you got your principal guaranteed, but you didn't get any return. But then if it was worse than 1120, if it was negative 25, you got negative 25. So here's our summary of what happened in 24. We had 24 notes that got called. So that's great. And we only have 2 going into their second year, 8 going into their third year, and 2 going into their 5-year. So since 2013, since we've been doing these, we've had 150 notes called with an average return of 13.25%. Okay. On to the sister note. These are the income notes. We've actually increased our weighting in income notes these days. And we had, these things get called. And when they get called, why do we have so many getting called? You did not have 34. Okay. Everybody gets the ones that they get. But you have a year where they don't get called, a year where they don't get called. Then the overall market's up and they all get called. So that's what happens. So we had 34 called. We have 28 currently open. The average income is 9.07. And these ones pay monthly, and we track them every month, and we received all 474 payments. And these pay every month as long as the underlying investment is above the barrier of -30. So even if it's -10, -15, it doesn't matter, it still pays. I like to talk about our ESG. We run the portfolio through once a year because it is important. We use Morgan Stanley to see how it rates the stocks we hold, and we're still running at an A, so that's good. And here's our asset allocation. So this is what we're looking at doing for next year. I think what you would notice is that, fixed income is still pretty reasonably small at 10%. The income notes have been favored over the auto-callable notes because I want that monthly income. REITs are pretty small, and an increase in international equity, a preference for U.S. equity over Canadian. And here is your silver lining about Canada, is there has never been a period of time where U.S. GDP increased by 2% that Canada did not increase as well. And that's why we're lucky to be Canadian, because we're going to go along for the ride. These are the sources we use to help us make our decisions. Some are cheap and some are not. These are our very important lawyers saying hello. They're here. Don't forget about them. And finally, here's our team of people that you talk to when you phone in addition to me. So that's the official part of what I wanted to talk about today, and I will be happy to take any questions.
I'm just wondering what the effect is of ultra rich, how they affect the market or the policy.
How do the ultra rich affect the market or the politics? Okay, first of all, I have to figure it. Are you talking about American or Canadian?
Either one.
Okay, I would tell you how they affect politics is I always visualize voting like a pyramid, okay, like this. And there's always less people at the top for wealth. It doesn't matter where you move your average, there's always going to be less people at the top, because as we achieve success as a society, we always want more. You look at 1950 when everybody had a single house, they were happy with 600 square feet, right? Now, if you have less than 2,000 and you don't have stainless steel appliances, people are wondering what you've done wrong. So as your standard of living keeps increasing, so there's always less people at the top. But those smaller people at the top, they get the same number of votes as the people at the bottom. So it's very, very easy to say, it's only going to affect these small people. And we heard Chrystia Freeland say that when they changed the capital gains tax rules. It's only a small group of people it's going to affect. But you know what? That's not true, because it was a lot bigger group, but also that's easy to get past. And the first time in my academic history, because I wasn't there, that I recall that being a successful political program was, it went like this. This is a temporary measure only for the rich that will end at the end of the war. Guess what that was? It was income tax. Only the rich. So I'm going to tell you that they use the rich people to get the votes, and then they give it to everybody. That's my political experience. Ultra rich people, so people, I don't care how you define it, but when you look at your tax dollar, if you are a low-income person, for every dollar you pay, you get about, I don't care, I'm making these numbers up, but call it $10 in benefits. When you're an ultra-rich person, you get 0 benefits for the dollar that you pay. So if you don't get tax benefits for the dollar that you pay and you're ultra-rich, you can choose to leave. So that's how I look at it. I lived in Europe as well, and in Europe, countries don't actually really, the tax rates are so high that they basically, when I was living there in 1991, they basically abandoned the concept of capital gains taxes and taxes on those types of things. They made it all income taxes because that was where they were going to get all their money. Anyway, yes.
You talked about Canada and the U.S. What about the rest of the world and the war situations in the two different regions?
Yeah, wars are never fun, right? They definitely caused destabilization. And when the Ukraine war broke out about 3 years ago now, I took a look, and what I'd realized was since the year 2000, there had been over 50 global conflicts. We just didn't pay attention to them. So when I look at the wars that are happening as destabilizers, there are short-term destabilizers, and then as far as the economy is concerned, we just basically get used to it. So you don't get the volatility. And
I did note in your thing you said the Canadian dollars ranges 140 to 150 this year. So maybe your comments on that.
okay, so what's it going to take for the Canadian dollar to turn around? Number one, we have to get some of our problems fixed. Right now, the trends aren't good, so we need something that's going to cause a catalyst to change the trend. And then after the trend is changed, we need some time for it to take effect. So those are the two catalysts that I'm looking towards. Until then, unfortunately, interest rate differentials are going to be a big one. But guess what? Again, this sounds ridiculous, but when we have that cheap currency, we could attract a lot of good quality jobs to Canada, specifically in the IT sectors. We're now competitive to places like Europe and China and for manufacturing. So that could be a real opportunity for us if we do it well as a country to take advantage of this temporarily low price. It's a Canadian dollar, I hope. Yes.
Could an election be one of those catalysts?
Well, we need an election to get a change in policy, to get a change in the trend. One of the questions I do get asked is about the capital gains tax, if that's going to get reversed with a new election. And I'm going to say, well, when's the election going to be? Right? If the election's not until November and the new government, or October, and the new government doesn't take over until January, CRA is not going to give the money back. Right? So I think that even though that would be hopeful to see, I also think that there's a real problem where I always liken the Trudeau. Trudeau is at the end of his regime there as a teenager, having a party, drinking all the liquor, knew he was going to get caught, burning the house down. So when the new government gets in there, if they went and started canceling all these programs that he has just put in, they're not going to make it through a single term. Right? So it's going to be hard. And who knows where there's been a huge amount of financial commitments and they're going to have to be paid for. So it's tricky. Glad it's not my job.
But the capital gains didn't pass. Died on the order paper, the capital gains change.
It's not passed, but CRA has taken the position, I believe, that they're collecting it.
Yeah.
So I was at a law firm luncheon, and it wasn't about this, it was about estate tax. And the law firm was basically saying, this is not passed, this is not legal, but CRA is taking the position that they have to pay, and they won an appeal. So I wouldn't want to be on the other side of that trade right now. And I don't want to pay tax. Okay, please don't get me wrong. I'm happy to pay my fair share. I don't want to pay bonus tax or extra tax. I'm not a pro-tax person in that sense. So I would like to be wrong. I would like everybody that pays their tax to get it back.
So this year you made really good returns on investments.
Yeah.
What do you see in this year that you figured that you only do about half that?
You never look for that kind of a return, right? I look back at how long I've been investing now. It's been 25 years that I've been doing this professionally. And I've had other years where I've had high double digits. And those happens when your stars align, right? You happen to be in the right things on the right side of the trend. And some other things happen, like we had auto-callable notes that were, zero return, then they showed up at 76, right? So there's all of these different types of things. But you don't need that every year. It's just fun to have it sometimes.
I wouldn't mind if it's every year.
Oh, well, thank you. Yeah, no. You know what? In my industry, for me personally, I have to put myself in a position where you don't chase aggressive returns. I don't chase aggressive returns. We get good returns from solid companies, and there is a big difference. In the beginning of my career, when I was at Merrill Lynch, oil and gas was really hot. Income trusts were really hot. I knew every junior oil company in town. We would analyze how many barrels they were doing, when they would get to 2,000, who was going to buy them. We were getting pretty good at it. Then all the rules went out the window in 2006. But it's not like that now. It's very, very different. So I look for long-term trends. And you would see, as to my energy trend, you'd have seen you've had Cameco added to your portfolio. That's intentional, right? The problem with nuclear is that it's so long to get it up and running, right? Even that big acquisition, Dustin, I can't remember, when is Microsoft going to be, get the 3 Mile running? 2028, right? So it's a long time coming. And that's just recommissioning a decommissioned facility. It's not building anything. But people are lining up. They're lining up to get their ducks in a row with the expectation of increased energy requirements as per AI.
So I didn't talk about electrical vehicles and what the future of those probably would be. Are we going to actually have 100%? And what will that do to our power grid compared to AI?
Okay, that's a great question. I've never been a fan of EVs, and I'm not a fan of EVs, nothing to do with the fact that they don't emit, because I'm a believer that you have to look at the full cost of production and all the emissions from the beginning of mining to the end of getting rid of the battery, okay? I think you have to look at the whole thing. I've talked to people who are experts who've told me that if 10% of Calgary had EV vehicles and plugged them in at night, we would have deaths in a cold snap. We don't have the power grid. But what I do think is going to happen, I think hybrids are going to be the winner. All day, every day. So with a hybrid, you don't have to plug it in. You put gas in it. You're not abandoned if it's cold. I think that's what you're going to see. And I think that that's an issue for energy as well, as that gets more take up on more types of vehicles compared to EVs. I think EVs will be in the future, and EV is going to be similar to a full gas car. I don't even know how to say that sentence. A car right now that just runs on gas, there'll be a niche. An EV will be a niche. The broad market will be hybrids. Okay, well, I think that's it. Thank you, everybody, so much for coming. I really appreciate it. Take your notepads, take your pens, call us with any questions. We're here. Okay, thank you.